Hello everybody. So today I want to talk about index funds. Rarely talked about it in the channel, but a day like today in the market makes me think about index funds because, sometimes you have to buy an index fund, right? Sometimes in your retirement account, all you can buy is an index fund, an ETF. And oftentimes you'll have a choice between the S&P 500 or total stock market index fund, which are highly correlated, like 97%, or you'll have a choice with a growthier index fund like the NASDAQ, which is the most common one. And when I look at days like this, I'm like, the NASDAQ is strongly outperforming the S&P. And actually, if I think about the past 5 years, I've seen more and more time on more and more days the NASDAQ outperform the S&P. And so I'm like, well, why is that? It's tough to understand. Since the famous Jack Bogle book on index fund, this common thing in finance is this common idea is that nobody can beat an S&P 500 index fund. The S&P 500 is a foolproof investment. It's you buy one index and it's done, right? While the NASDAQ is discussed as this volatile stock, we go back to the 2000s bubble and talk about these stocks as being so volatile, and it's a bubble and it's fake. And so I'm asking, is this changing? Because remember that the whole idea that promoted index investing, and especially S&P 500 investing, was the Jack Bogle books in the 90s, before we had the current revolution, right? The current roaring years that we're having in terms of innovation. These years, the 80s, the 90s, not nearly as innovation-filled as we have today in the 2020s. And so when I look at the data, and I think looking at the data should put, should kind of decide, how you act. I'm very data-driven. When I look at the data, I see that the triple Q, right? So the NASDAQ 100, the top 100 stocks ranked by market cap, outperform the S&P 500 over the past 24 years. Well, 24 years, you're getting into 2/3 of one's working life. So all I can say is that for 2/3 of someone's working life, the advice of putting the S&P 500 has not been the proper advice. I mean, I'm not giving advice. There is no advice given by anyone. Anybody just chooses and does whatever they want. But clearly over the past 24 years, that has not been true. And you actually have to go back to the data of much longer ago to make the claim that the S&P 500 is a better investment than tech stocks. And there's my calculator. This is my calculator of stocks. Like I go over a few of the stocks that were called bubbles, right? A few of these stocks that people in 2000 called bubbles. And so keep in mind, while many of the stocks like pet.com, for example, went bankrupt, others did not go bankrupt. Like this is an example of, say, Priceline, which renamed into booking.com. Priceline outperformed handsomely over 24 years of S&P 500. But then we get into the other type of stock, which breaks the ticker tech app right here, which breaks this total return app entirely. Where you have Amazon that breaks it with 31% return instead of 8% for S&P. Netflix breaks it with 30% return instead of 8% for S&P, and Apple same kind of breaks it so that you can't even reach the chart. You'd need a log chart in order to be able to visualize half that chart. That's so much the performance has been, right? The performance has been so strong. So again, and there's countless NASDAQ stocks that are like that, right? That survived. So while some bankruptcies happen in the 2000s and bankruptcies happen in both indices, I don't want to say that they don't happen in the NASDAQ. I would argue that the S&P has had much bigger bankruptcies and much more established companies with much bigger weight in market cap go bankrupt. That is what I'm arguing here based on what I see. And the Lehman Brothers bankruptcy, again, it was a major place of the S&P benchmark for the longest time. So was Enron for the longest time. You were putting money into stocks like Enron bankruptcy, and then all of a sudden these stocks go bankrupt and disappear. They disappear from your index, and it gets conveniently replaced when you calculate the index. It gets replaced by a new company that takes the spot of the old company, as if these spots don't really move too much. And the S&P is managed by a committee, right? It's entirely different from the NASDAQ, which is a market cap weighted benchmark of modern day industrials, right? And it's kind of, the NASDAQ is kind of like who has the biggest market cap wins. The S&P is who has the biggest market cap wins, but after being screened by a committee, which is I think a fundamental distinction. You have to go through a committee, and so the NASDAQ, and in the version that most people buy of the NASDAQ, which is the NASDAQ 100, it's all of the modern industrial companies without the financials. That's what most people who buy the NASDAQ buy. And so, for example, if you look at the NASDAQ, Tesla was listed in the NASDAQ from the start. And you'll see next slide, I have other stocks that have been listed in the NASDAQ from the start. So whenever a company lists on the NASDAQ and you have a NASDAQ fund, you're getting access to that upside. And look at the upside that you got into access by owning the NASDAQ for Tesla, right? 60% annual return over the past 10 and a half years for Tesla. Absolutely insane. Until 2020, not until today, right? I stopped it at 2020 to show that this is when Tesla was added to the S&P 500. Tesla was added to the S&P 500 in December of 2020. And so you would have missed out on 60% average annual return over a 10.5-year period. That's what you would have missed out if you own the S&P instead of the NASDAQ, because that stock was included in the NASDAQ from day one, and so were many other stocks. And I would argue one of the big problems of the criteria that the committee uses to choose inclusion in the S&P 500, one of these big problems is the fact that you have to have earnings, positive earnings in the most recent quarters and for the fourth quarters. And this, to me, ignores the reality that a lot of technology firms have to lose money, sometimes for decades, in order to be able to be the winner-take-all or the winner-take-most player in their market. Growth stocks, tech companies reinvest heavily in marketing, reinvest heavily in R&D consistently so that they may show positive cash flow and they may show adjusted EBITDA, positive adjusted EBITDA, but they are not going to show GAAP profits, right? And the problem is that the S&P uses GAAP profits, GAAP earnings. A lot of these companies also get penalized and don't enter the NASDAQ because they issue stock-based compensation. And of course, stock-based compensation hurts GAAP earnings, even though I would argue in general it has a good effect on the business because it motivates your employee and it doesn't take cash out of the business, so it makes the business more anti-fragile. So there's a lot of companies that could be in the S&P 500 that are not in the S&P 500 because it uses, in my view, a criteria that is not adapted to today's growth company, to today's tech companies, and to the way businesses work today. A lot of businesses today just go into growth and approach growth in a much, much different way than they used to. It's not about profits right now. It's about profits much later down the road and putting strategic imperatives like satisfying the customer, growing market share, these imperatives putting them ahead of things like, say, GAAP profitability. And, there's a lot of innovators in the NASDAQ that are not in the S&P 500. For example, Airbnb. Airbnb is a company I follow on this channel. Airbnb is a big company. It's much more than just a disruptor of hotels. They're trying to disrupt vacation, create induced demand for vacation. They're a low-cost leader in vacation, actually, if you travel as a family. They're entering the short-term rental market. And I think eventually, and this has been discussed on calls, they're going to try to disrupt the mom-and-pop rental business, which is crazy. And that stock, of course, Airbnb, a major company, is not in the S&P 500. Many of these stocks I don't follow on the channel, like Snapchat, Uber, DELL, NXP Semiconductors, these are not on the S&P 500 either, even though these are major companies. Same for Square. You have PayPal in the S&P 500, which is an innovative company, but arguably not as innovative as Square, not growing as fast as Square. Why is Square not included among PayPal in the S&P 500? A lot of the SaaS names that I discuss on this channel, like Snowflake, Zscaler, CrowdStrike, MongoDB, these companies have amazing growth profiles, and they are not in the S&P 500 because there is no category for them. There is no spot available. So the world is slowly moving away from a world of clearly defined legacy industries, legacy companies, to a world of software, tech, and industry 2.0. And that's what Mark Benioff famously said in the early 2000s, which is software is eating the world. And we are going from a transition from the industrial age right now to a more software, AI-driven age, just like people in the Gilded Age, people before the 1900s, at the end of the Civil War in the 1900s, slowly transitioned from agriculture to industry. You had most people working in agriculture, and then all of a sudden, fast forward 30 years, one generation, everybody works in industry. I believe we're in that same process where tech is an imperative, and a lot of companies have to transform or be disrupted by tech companies. And so I see a lot of disruption happening for companies in the S&P 500. I do see some disruption happening in the NASDAQ as well, but I see fewer disruption in the NASDAQ than I do in the S&P 500. And let me just go through 6 different quick examples. So, for example, the talk of this week and past week has been financials, overly leveraged financials that are being hurt, right? These financials oftentimes can't compete and can't provide competitive rates, say, on deposits. So a lot of people are withdrawing their funds, moving their funds to higher paying deposits to fintech companies. And that creates a lot of turmoil for a lot of the banks, for example, who have long dated maturities on their bonds. And it's like they may have to sell those bonds at a loss. At least that's what happened for SVB. That's why the Fed has to introduce a backstop so that this doesn't happen anymore. So we've seen a tremendous drop in the financials. But these financials are getting disrupted in the short term right now by fintech, right? I have a whole series as to why fintech and neobanks are going to win, I believe, over consumer banks, but also neo payment processors. It's much cheaper to go through a closed loop payment processor like a Square than it is to go through a Visa or MasterCard. So there's a lot of disruption happening. These companies have to defend their rent. They are in more of a rent-seeking mode, not in an innovation mode. They have to defend the rent. It is a tough position to be in. And over the longer term, even some fintechs may get disrupted by public blockchains and decentralized platforms, these semi-autonomous organizations that run on their own through code. And so I believe over a longer term, they have an extra threat on top of the current fintech threat. And so that disruption, I believe, is going to have some sort of a blast, within all of these companies. And it's already started with 2 companies being gone, right? Signature and SIVB. Moving on, what else, right? We have industrials, traditional industrials, in my view, they're getting disrupted. We have a lot of changes in Industry 2.0, 3D manufacturing, new manufacturing techniques. There's a change, for example, in how companies manufacture their plants today. Today, companies try to centralize plant, have the biggest plant possible, because when you have a large plant, you produce more per input, right? Each input produces more the bigger the plant is. The fact that we've made so many advancements in technologies mean that the classic economics of diseconomies of scale applies less and less and less. And so you have kind of a gigantic era of manufacturing where a lot of these new industrial companies are building major plants, some as long as a mile long, in order to manufacturing this, as opposed to legacy companies having sometimes hundreds of plants connected through networks of trucks and buses and et cetera, et cetera. So I think there's going to be a lot of disruption. Keeping in mind that a lot of these industrial companies have inertia, tremendous industrial inertia that prevents them to change. I also believe sometimes it's unlikely to imagine, but even things as stable as the airline may be disrupted. If you look at what's happening with eVTOLs, if you look at what's happening with SpaceX, there may be some disruption coming to the airlines within 20 to 30 years. And if you invest, it's technically for retirement in general, so you care that there's going to be disruption. Even if it's 10 years from now, you care that there's going to be disruption. These companies could move, could change, but they have 2 issues, right? They have a lot of debt. That's a major issue. Financial debt, technical debt. But they also have non-agile unions that are going to come and bargain every other year and want major bargaining contract that sometimes endures the right strategy that a lot of these companies could do. Keep in mind, either for financial or industrial, I'm not claiming all of these are at risk. I'm claiming many of them will be at risk. The last one that comes to mind, for example, is when I look at the railroads. If you have a network of autonomous trucks, what is the role of a railroad in that world if you have autonomous trucks who are going to get much cheaper than most people imagine? Let me move on. There's more, right? What else is going to be disrupted? So when I look at real estate, I think a lot of warehouse companies are very safe. But if you move away from warehouse and take a minute to think about what the bulk of the real estate sector is, for example, here, it's office and commercial. Office and commercial is the bulk of the real estate sector. So I think the megatrend of e-commerce is not done. We're at about 30%. The megatrend of e-commerce is going to continue. And we've just started a new megatrend with virtual work. I know right now a lot of companies are bouncing back from virtual work and telling their employees to come back to the office, but it doesn't change the fact that virtual work was on the rise before 2020, and it's a mega trend, and virtual work is going to be just so much more common, I believe, in this decade. Last one to think about is autonomous car. What is autonomous cars? What are they going to do to our infrastructure, to all of our real estate infrastructure? Do you need as many parking lots? Do you need to organize the same way if you have fewer cars on the road? Here's another one, energy. You know, in this channel, I talk a lot about STEM, Enphase, Tesla, distribution storage systems for energy, storage for energy from during the day until the night, virtual grids. There's so much going on for energy. This is going to impact both the energy sector right here, as well as the utilities sector, who is getting impacted. The utility sector is going to be impacted just the same way. They have a lot of debt, whether it's the traditional energy oil sector or the utility sector. They have a lot of debt, and they are threatened, I believe, by a lot of the energy revolutions that are happening. Solar energy coupled with batteries, in my view, and it will become clear to most people, is the cheapest way to generate electricity. And whether it's batteries or solar panels we're talking about, we have almost dumping behavior from places like China, places in Asia, where these technological innovations are just so common and so prevalent, and the cost is going down year after year after year. When I do these videos on batteries or photovoltaics, you probably hear me talk expecting at least a 4x cheaper by 2030, right? They have declining cost curves that are beyond what we imagine today, notwithstanding the fact that they're already cheaper today. Right? The EV, the energy independence revolution is also related to an EV revolution. And I believe a lot of companies like GM and Ford are going to have problems transitioning because of their legacy debt, because of their technical debt, because of their financial debt, and their unions who are going to be anti-change. And the last one that I'll talk about is Neobrands, right? A lot of the old brands that we created in the 50s, 60s, 70s were related to the rise of television. Because every household had a TV at home and watched the evening news, a lot of brands were able to grow and develop. But as we move away from television, these old brands don't mean much to the Gen Z consumer, to the modern consumer, right? Tide probably means quite a bit to you if you're in your 60s, but it probably means way less to you if you're in your 20s. And so that's why a lot of legacy brand, be it clothing brands, store brands, food brands, a lot of these legacy brands are being disrupted by Neobrands who are able to advertise and create direct-to-consumer brands that resonate better with the consumer. So I also think in sectors such as the consumer defensive sector, you're going to have quite a bit of disruption. And so this is just a preliminary video on this idea of disruption. I want to develop more disruption and discuss it more in general on the channel. More videos will be coming on the topic. Keep in mind, I am not making sweeping statements. Each company in those buckets that I kind of highlighted here, each company needs to be assessed independently because it's more complicated than that. But in my view, the pressure on certain sectors will be much greater than the pressure on other sectors such as technology. I think there will be way less pressure on technology, for example, than on, say, industrials, utilities, or financials. So this was not investment advice. This is just entertainment. Thank you so much for watching. I appreciate your likes and your subscribes. I appreciate if you'll follow me on Twitter. Thank you all for your support. I'm so happy to have more than 1,000 followers now. So thank you all and have a great day.